So I hope there are no questions that you have on what we have learned so far. So if you have, just raise it, maybe say towards the latter part of the class today, and let's quickly move on to the new topic. Okay, so as part of the accounting process, where the manual book entry bookkeeping is concerned, that is, nowadays we know that we are using computer systems for us to record transactions, but when you consider the manual bookkeeping, which was taking place for a longer period up to now, and even some of the companies still follow the manual bookkeeping process. So where those companies are concerned, and if those are like trading businesses, then these prime entry books will come into the play. And also, like, as part of any business operation, the cash inflows and outflows, that is the cash that is coming in and the cash that is going out, is also part of the business. So you need to record all the cash inflows and outflows, and this part of cash inflows and outflows are recorded in one of the books of prime entry. So the cash book is also one of the books of prime entry. So we need to be very clear about what these books of prime entry are, even though we may not use it on a day-to-day basis in our business operations, as well as a learning process also. We will not come across in detail regarding these books of prime entry, but just for knowledge and how these books of prime entry will serve various types of businesses in recording transactions is very important. And on the other side, what we talk about as journals is where you record transactions in the books of prime entry as and when the transaction happens. Then from there, you need to take these transactions as accounting entries, as we learned already, the double entry, based on the double entry principles. You need to take them into the ledger. The ledger is the book. So into the ledger, how you are going to take it there is by way of journals. We call them as journals. So we will learn what the journals are that are required for you to take transactions from the prime entry books to the general ledger. And also, journals is a common subject as far as accounting is concerned, because any transaction that you may record requires a journal. So for example, let us assume, being a banker, we know that when a customer comes for a deposit, it's cash deposit with the bank. So how do you accept this customer's cash deposit? As you know, you accept a deposit slip signed by the customer with the particulars such as account number, account name, and the amount involved. So all those information will carry in that deposit slip, and that is what you will make use of as the source document for your transaction. So your journal is originated or generated based on that source piece of paper, which is called the deposit slip. Similar to that, you will do withdrawals also. So any transaction will have to be recorded by way of journals, and these journals are supported with source documents. So let's get into the subject. So to start off with, let us first understand what type of transactions do we have. We have two major parts of transactions. One is called a cash transaction. The other one is called a credit transaction. Now, cash transaction is very straightforward. That is, you either receive money or you pay money. Both these are cash transactions. When you receive money, that is a receipt. And when you pay somebody cash, that is a payment. So all receipts and payments which are happening in the form of cash is known as a cash transaction. But now what is credit? What is credit? Now, by now, all of you know that credit also refers, such as you all are using the credit card. Now, what do you do with the credit card? You can do a transaction at any point of sale where this relevant trader allows you to do a transaction using your credit card. Now, when you use your credit card, what happens there? You purchase the product or the service and you don't pay for it. What do you mean by not paying for it is you don't pay cash immediately. So the transaction happens, you receive the end product or maybe the service, and the seller is also happy with the transaction because he receives the money, but not in the form of cash immediately. And both parties are satisfied as far as this being a monetary transaction. Now, what is going to happen? By using the credit card, you commit for a liability or an obligation to pay for it at a later date. So you do the transaction today, which is called a credit transaction, but you pay for it at a later date. At a later date. So this type of a transaction is known a credit transaction. So this is something very common which happens in all business trades where people enter into a lot of transactions. All those involve credits. So what is the cash transaction? As I told you, the buyer, that is person who is buying the product, chooses the goods to be purchased and you make the payment immediately. So you need to be sure whether you carry that amount of cash with you to make the purchase or obtain the service. So whether it is a product or a service, you obtain or purchase it and you pay for it immediately. But what are we talking about as credit transaction is, a credit transaction would be where the trader or the service provider should be willing to provide you credit. Now, there are certain businesses where they don't permit credit. So if they permit only, you can enter into a transaction where you purchase the good or obtain the service and pay for it later. Now, this payment later means not to the person who is selling the product or offering the service. It is to a third party. Now, when you enter into a credit transaction, there are two types. Now, when we make use of the credit card, that is a transaction which involves three parties, the tri-party transaction. But what we are trying to learn here is where you enter into a business transaction where the trader himself or the seller himself is willing to accept that delay in getting the payment. Okay, so what happens here? The payment is made at a later date than the delivery of the goods. So this is slightly different to what we have been talking about using the credit card. Now, in the case of a credit card where it is a tri-party transaction, so you have an obligation to the bank and bank has obligation to the seller from whom you have received the goods, and the bank will ensure the payment is made and you will ensure that the payment is made to the bank at a later date. But what we are talking about here is not that. This is where the trader himself is directly offering credit to the buyer. So the trader agrees. The trader means the seller. The seller agrees to the buyer, okay, you purchase the goods now and you pay me in 2 months' time. So he offers a time period to the buyer to be repaid. Now, when can this happen? Can you just go and step into a shop and ask for credit? No, it won't happen. So this credit transactions happen over a period of time through business relationship where there is a trust is built up. So based on this trust only, the seller and buyer will agree or come into an agreement to purchase goods or sell goods and make the payment or receive the payment at a later date. So what will happen here? The goods will be delivered in advance, but you will make the payment later. So these are the two broad classifications of transactions, which are known as cash versus credit. Cash versus credit. Now, why this cash versus credit transactions come into the picture of prime entry books? Now, as I told you, when you do a cash transaction, that is directly receipt or payment of cash. So you go and enter those type of transaction into a particular ledger book, which is known as the cash book. And this cash book is part of the prime entry books that we are going to learn, which we will take up toward the last part of this chapter. But on the other side, all other credit transactions that business traders will enter into are recorded in the remaining prime entry books. Okay, so whenever there is a credit transaction happening, this credit transaction needs to first recorded in the prime entry books. And from the prime entry book only, you will transfer that transaction in the form of a journal entry into the general ledger. So the purpose of the prime entry books will be to record all the T accounts. Whatever the business transaction that you may enter into, all those transactions will be recorded in the form of a T account in the prime entry books. So as you know, the businesses are getting expanded day by day. And the volume of transactions also grow. So as a result, the number of T accounts that you need to maintain becomes higher and higher. So every business should be in a position to manage the increasing number of transactions and the volume of transactions that take place along with the number of customers that you might have or the number of accounts that you might have. Now, this is a typical problem or the scenario when it comes to the banks. Now, when you look at banks, a customer banking with you might have several accounts. He might have 5 savings accounts, 2 current accounts, several fixed deposits, several loan accounts. So you need to maintain a comprehensive record of your customer in terms of all the transactions that the customer deals with you. So we don't come across the issue of maintaining T accounts or maybe the requirement to maintain prime entry books because the computer systems that are used in the banks are configured in such a manner where they look after this requirement of maintaining accounts. So it's a matter of just going and opening an account in the system. That is what we do. In banks, we just go and open an account in the name of the customer so that whenever we do an inquiry based on the customer, we get all the list of accounts that are maintained by the customer with the bank. Similarly, the same customer might go and maintain accounts in other banks as well. So those banks also will do the same. Now, this is from the banking perspective. Now, let's move on to another type of business. Let's take the telecommunication. So I will make use of the known example, which is the Dialog Asiata. So if you look at the mobile service provider Dialog, they recently, I don't know how many customers or how they call it as subscribers. I think that the subscriber number reached 4 million or 5 million recently. Now, what do you mean by this? they have provided mobile numbers which are amounting to 5 million. So out of the 21 million population of Sri Lanka, they have reached not 5 million people here, but here there are 5 million connections. Now what will happen? One particular customer of Dialog might have several mobile numbers, which is a very common scenario. So the company Dialog have to maintain a record of the customer and all the mobile connections that the customer has with the company. Now you can't do all these manually. It's not practical. Now that is what we are talking about today. The books of prime entry is theoretical, but it is very difficult to put it into practice in today's context, because day by day your business volumes increase, the number of accounts increase, so it is not practical for you to manage the prime entry books manually. So your computer systems are configured in such a manner to look after this requirement. Sorry. So the T accounts are now going to get classified into 3 ledgers and 7 books. So we have been talking about a ledger. Now all these T accounts are included broadly into 3 ledgers as far as businesses are concerned. Similarly, they can be confined into 7-day books. We call them as 7-day books or books of original entry. You can call it as prime entry. So what are the 3 ledgers? Firstly, we have to learn about the sales ledger. Then we call the purchases ledger, and most importantly, the general ledger. Now in a bank, I always take the example of bank because all your questions in the examination, if you go through, are mostly to deal with the banks. Okay, so you need to be very familiar with what is happening in the banks when it comes to how do we relate it to the business accounting subject. So in a banking scenario, it is very rare that you maintain these 3 types of ledgers. Banks do not maintain a sales ledger. Banks do not maintain a purchases ledger because the banks are not into the trading business. They are a financial service organization. So banks are mostly having the general ledger only, which is the heart of any banking book. So you have to be very clear about the differentiation, how these prime entry books or the ledgers operate within the business context. What type of a business will make use of all 3 ledgers, and what type of business will have what kind of a ledger. Okay, mostly the financial organizations might not have the sales and purchases ledger, but general ledger is a must. So as I told you, there are business transactions happening and you have to record these transactions. And in order to record these transactions, you need journals. And how you relate these transactions into journals is you make use of the double entry principle. So you will draw up all the debits and credits relating to the transactions, which involves the accounts also. And then you need to devise this transaction using a source document, which should be an authorized document. Now in trading businesses, there are several documents which are made use to record transactions. Okay, so these documents will be the basis to document the transaction, and it acts as the proof for the occurrence of the transaction. Say for example, a customer coming to deposit cash. Now the moment you accept cash, there has to be a validity with regard to the transaction. So the customer willing to give you some amount of money to be deposited by signing the deposit slip, which is the authorized document. And in turn, how does the customer is satisfied that he has deposited his money? When you return the counterfoil to the customer with the validation of the bank, giving a proof that you have accepted this cash. Now you see how this transaction becomes valid using the source document. The transaction originates with the deposit slip being signed and given to the bank counter staff. The counter staff processes the transaction based on the information available and gets the validation and gives the counterfoil back to the customer. So the customer looks at the counterfoil, looking at the particulars and what the bank's validation is. Based on the validation, the customer satisfies himself, the bank has accepted my cash and they have given a proof for my transaction. So as a result, the source document actually acts as the proof for the occurrence of the transaction. It also acts as a basis to record the transaction in the books. Now, as I told you, you will make use of this document to record the transaction. Now, what are the basic types of source documents for some of the transactions? As I told you, cash deposit by a customer, you will use a deposit slip. Cash withdrawal by a customer, you make use of a withdrawal slip. Purchase of stationery. Now, if you are going to buy stationery from a shop, what does the customer will give you? Customer will give you an invoice or a bill. That will be the source document for the transaction. So looking at the books of original entry or the prime entry books, there are altogether 7 day books or 7 journals, but we call them as journals also. So what are the 7 day books? Cash book, petty cash book, sales journal, purchases journal, return inwards journal, return outwards journal, and general journal. So these terminologies have to be very clear with you. That is, what is a sales journal, what is a purchases journal, what is a return inwards journal, and what is a return outwards journal. Okay, specifically the terms return inwards and return outwards. What does it mean? So the transactions that you may come across in a trading business can be classified like this. What are the types of transactions that you may come across in a trading business? There could be credit sales. That is, you are selling a product. Now, I am talking of this from the point of view of the business, not from the point of view of the buyer, right? So if I am the business, I might enter into credit sales. That is, I sell products to the customers where they agree to repay after a certain period of time. That is a credit sale. Then similarly, I might be purchasing goods from somebody else, and I am also agreeing to repay them after a period of time. That is called a credit purchase. So there is credit sales and there is credit purchase. So there are 2 types of major transactions. One is the products that you sell on credit. The other being the products or services that you get from others on credit basis. Okay. Now see what happens. You have sold products to your customers on credit basis. So before the credit period is done, sorry, these customers come back and return certain amount of products due to various reasons. Either the product is of not good quality or maybe it is damaged. You can have so much of reasons. So you have done a credit sale and now the customer is coming back and returning the product that was bought by them. So what is happening here? You did a sale. Now that sale is getting returned. Sale is getting returned. We call that as sales return. Sales return. Now the sales return is in accounting terms given another name. That is called returns inwards. Returns inwards. So that is a sale that is getting returned by the customer. Now similarly, whatever that you have purchased, also you might return them. Let's say you have purchased stationery on credit terms. Now after bringing the products into the business, you see that certain stationery items are damaged or dilapidated. So you might give it back to them. And that kind of a return is known as a purchaser's return. Purchaser's return. In accounting terms, we call it as returns outwards. Returns outwards. So which means something that you brought into the business is now going out of the business. That is called purchases or purchases returns or returns outwards. Now these are the four major arms of transactions in a trading concern. What is the end results? All these transactions have to be materialized into cash at some point in time. When the credit period is over, all these transactions have to materialize in the form of cash. So how does it materialize into cash? You know, transaction can materialize into cash by way of physical cash or checks, or by receipt of checks or by payment of checks. And now of course we make use of the credit card also, so which is also acting as part of monetary instrument where you can do transactions. But majorly when it comes to traditional businesses, one is the cash, the other one being the check, right? And apart from all these, a business can have other transactions such as paying for utilities, paying for your meals, salaries, rent, maintenance. There are so much of other transactions that happen. So you have four major business transactions: credit sale, credit purchase, return inwards, and return outwards. The result of which resulting in the cash or checks, that is another. And the last one being the most important, all other transactions that you can come across in a business. And in the second line, I have shown where all these types of transaction will get recorded. So here we have the 7-day books, or rather 6 or 7 day books, where 2 books are included in this. So what are the day books? Credit sales will go into the sales journal or the sales day book. Credit purchase will go to the purchases journal. Return inwards goes into the return inwards journal. Return outwards into the return outwards journal. Cash and check related transactions go into the cash book or the petty cash book. And all other transactions go into the general ledger. Now these 7-day books, as I told you, can be grouped into 3 ledgers. So all transactions resulting in these 7-day books will go into the 3 ledgers called sales ledger, purchases ledger, and general ledger. And these 3 ledgers will have accounts which are known as control accounts. So the detailed accounts are maintained in the day books. The total of those maintained in the control accounts. We will learn control accounts separately, but just for your knowledge at this point in time. So now look at how a transaction that we already learned can be recorded in the prime entry book using a source document. So I'll give you about 1 minute, just go through these documents and how it is recorded in the daybook. So here we have something called financial correspondence. Financial correspondence means, for, as I told you, the normal transactions other than the for trading and cash transactions, you can enter into several other transactions. Say, for example, payment of a utility bill. So you will get a utility bill, which is the financial correspondence that you might have. Similarly, payment of salaries, payment of allowances, maybe doing maintenance. So much of transactions are there. So all those are grouped into financial correspondence. And this table is very important because, sorry, in one of the exams, I think this was tested. So you need to know what are the source documents with relating to the prime entry books, and what kind of a transaction that can go into these prime entry books. So now we are going to look at the T account classification. This is how it will be. So in your ledger, you will have accounts. You might have millions of accounts. We don't know. These accounts can be grouped into two. We call them as personal accounts, impersonal accounts. So now you have an idea that personal account means that relates to the individual business transactions, where you have to do a transaction in one particular named person or a named business. You can sell products to an individual or to a company. So all those are personal accounts. And the other side is the impersonal accounts. Impersonal account, whatever the transaction that is recorded in an account which is other than the individual or a company account will be an impersonal account. So where does the personal accounts lie? In the sales ledger and in the purchases ledger. So you know what are the day books going into the sales ledger and what are the day books going into the purchases ledger. Say, for example, if you look at this, sales journal and return invoice journal will go into the sales ledger. Purchaser journal and the return outward journal go into the purchase ledger. Rest of it goes to the general ledger. Okay. So the total of these will go into the control accounts. The total of all the individual accounts, personal accounts, will come into the control account of debtors or the sales ledger, creditors or purchases ledger. Okay. Now I am introducing two terms here which will go through the entire module, this accounting module, where you will have to use. I am introducing the term debtors and the term creditors. Who is the debtor now? Debtor is, from the business point of view we are talking about. You have to always look at the transactions from the business point of view. So from the business point of view, who is a debtor and who is a creditor? Very important. Debtor is the person who has purchased goods from the business on credit terms. So let me put it on the board since we are can explain. I hope the board is visible to you all. Now let's look at this. Let's take ABC company is a business. ABC company is a business. Okay. Now there are transactions happening with the company. There are a pool of customers. Now, with this entire pool of customers, you enter into credit sale. Okay? So you are the one who is selling the product, right? You are the one who is selling the product, and it is happening through a credit sale. So what does it mean? The product is sold today. So the product is delivered, and the payment is later. Right? Payment is taking place later. Now I am looking at it from the point of view of ABC company. Now for ABC company, all these customers are debtors. From the point of view of ABC company, all these customers become debtors. Is that clear? ABC company is the business. All these customers are doing credit sale with the company. You deliver the product, you receive the payment later. So if that is the arrangement, then you know from the business point of view, all these customers are known as debtors. All these customers are known as debtors. Please remember, this is only in the case of credit sale. If these people have paid the cash immediately, the transaction is over there. There are no more debtors. Debtors means somebody who owns money to you. Somebody who owns money to you. Similarly, the same company can enter into, let's say, they are purchasing stationery in bulk from a company called XYZ Stationers. XYZ Stationers. So what happens here? You purchase from them. You purchase from them. So that is a credit purchase now, because you are not going to pay immediately. You are not going to pay immediately. How does it happen? They deliver the goods immediately. And you pay later. You pay them later. You see, the same company again. They are doing a credit sale with pool of customers, or it could be an individual, or it could be many. And similarly, they are doing a purchase which is on bulk purchase on credit terms, where the goods, they will receive the stationery immediately, but they will pay it for later. Now, until you pay them, from the point of view of ABC company, XYZ Stationers become your creditor. And put it in plural, let's say creditors. This concept is very important. You need to know who is your debtor and who is your creditor from the business perspective. I would like you all to take down this. If you are not clear with anything, just you can raise me the question. Please take down this. This is very important. This is not there in the handout, so I would like you all to take down. I hope what I have written in red is visible to you all. Anything is not clear, just send me a chat. So let me explain it once again, just for the benefit of those who didn't understand it. Okay, so now ABC company is the business, and they are the ones who are maintaining the prime entry books. So we are looking at the books of ABC company, how they will record transactions in their prime entry books. And they are a trading business concern, they sell products. So what happens? People will come and buy from ABC company. There are two ways of transactions. One is where they can purchase goods and pay ABC company immediately cash. That is a normal cash sale, no problem. Let's say Mr. A comes, buys products, pay cash, done. That is over. Now let's take another customer, Mr. B. Now Mr. B is a long-standing customer of ABC company, and he purchases goods in bulk, not like the earlier person. He purchases goods in bulk. So what happens when he purchases goods in bulk? He would like to enter into an arrangement with ABC company to make this a credit sale. Make this a credit sale. So by doing that, what will happen? Mr. B will receive the goods from ABC company now itself, and he will pay later, payment later. Let's say within, just for example, 30 days. So you receive the goods today, but Mr. B will pay ABC company in 30 days from now. Now, when that happens, this becomes a credit sale. This becomes a credit sale. Now this credit sale have to be recorded, right? Just like the cash transaction, this also needs to be recorded because ABC company has sold goods. So for that there has to be a record. Now that record, we will record it in the books of prime entry. Books of prime entry. I will explain that later. But what are we trying to understand now? There is a business relationship between Mr. B and ABC company. And Mr. B is having an obligation to pay this money to ABC company within 30 days. So as from the point of view of ABC company, Mr. B becomes a debtor. Okay? A person who owes money to the company. Mr. B is a debtor of ABC company because Mr. B is supposed to pay for the goods in 30 days time or within 30 days time. Is that clear? Now similarly, ABC company also will enter into various types of transactions. One of such transactions is where they are buying stationery in bulk. Because when you purchase one A4 packet or maybe something, you will pay cash and buy it. You will not go and ask for this one A4 packet thing for credit. It doesn't make sense, ABC company being a company. So when there is a bulk purchase, normally you will expect a credit to be offered. So what happens here? They purchase stationery, goods are delivered immediately to the company, and you agree to pay within 45 days. Within 45 days. So ABC company will pay XYZ stationers within 45 days for the stationery that they purchase. Now what is happening here? ABC company is going to have an obligation. Okay? ABC company is going to have an obligation to pay XYZ stationer within 45 days. As a result, XYZ becomes a creditor to ABC company. To ABC company. Okay? Now look at it from the point of view of the elements of the accounting equation. ABC company is a business. Anything that is receivable to you, anything that is receivable to you, what it is? Anything that is receivable to you is known as an asset. So debtors are assets of the business. Debtors are assets of the business. What is here? You have an obligation to pay. What do you mean by that? That's a liability. So debtors are assets of a business. Creditors are liabilities of a business. These things you have to be very clear. Because as we go on, I will just keep on saying debtors, creditors. You should know whether debtor is an asset or a liability, like creditor with the asset or liability. So you will come across these terms even in your day-to-day business operations. When you evaluate customers, you will come across these terms. So this has to be very clear. In terms of definition, what do you mean by debtor? Debtor is a person, or we may call it as an entity, who owes money to the company. Creditor is an entity to which the company owes. That's what I'll call. This is an asset, this is a liability. So creditors and debtors, you don't need to define such. It's not that kind of a term where you need to define it, but generally what you need to know and you should be able to write in your own words is Debtor is a person who owes money to the business. Who owes money to the business. Creditor is a person to which the company owes money. Company owes money. Okay. Right. Now what is going to happen? All the transactions that you record for a credit sale goes into the sales ledger. All transactions relating to the credit purchase goes into the purchases. Okay, so I hope this is very clear to you because this is very important as we go on further. Okay, so sales ledger relates to all credit sale related transactions going. Purchase ledger related to all credit purchase related transactions that will go in. Say for example, you do a credit sale that goes into the sales day book. From the sales day book, it comes in here. When this customer, Mr. B, purchase goods, no, he comes and returns. Then it goes into the sales return day book or return inwards, and from there it goes to the sales ledger. Similarly, for the purchases ledger, it is in the purchases day book and the purchases return or return outwards day book. Okay, so I hope it's very clear now. Let's get back. Right. So this is where we were. I just wanted to explain what is debtor and what is creditor. So I hope now it's very clear to you. And why we call it as personal accounts, I will make use of the same example. Now here you will see Mr. B. Mr. B is one of your debtors. So you have to maintain an account in the name of Mr. B. That becomes your personal account. Okay. Similarly for creditors, you need to maintain an account in the name of XYZ stationers. Why? Then only you know how much you need to pay to XYZ stationers. Likewise, you might have several debtors and several creditors. So you need to know the details of all those debtors and all those creditors. On the other side, we have the impersonal accounts. Impersonal account. What do you mean by impersonal accounts? Those are classified into two broader categories. One is called a real account. The other one is called a nominal account. What do you have in the real account? Sorry. Records all the assets and liabilities in the general ledger. Now you have to understand this very clear, right? Even in the personal accounts, you have accounts which are going into the sales ledger and purchases ledger. Impersonal accounts, where you have real accounts and nominal accounts, going into the general ledger. Okay, general ledger. So here all the assets and liabilities will go into the general ledger. Here nominal accounts means all your income, expense and capital accounts. So what do you have really here? The components of your accounting equation. Assets, liabilities, income, expense and capital. That is the fundamental that will take on throughout this module, where you will come across the terms over and over again: assets, liabilities, income, expense and capital. Right. So let's get on to the sales ledger, or the sales day book, sorry, sales day book. Now what happens? This is how the sales day book will look like. Just have a look at it. This is just a sample. People can have any kind of sales day book, but this is something very basic. You have the date of the transaction. If you have an invoice number, definitely you will have to have an invoice number. That invoice number will come here. Buyer. So who is the buyer now? In a sales journal, let's say Mr. B. Mr. B is your buyer. Description. What did he purchase from you? Say, for example, if you are a company who is selling toys, you will give a description of the toy. Quantity. How much of quantity did he purchase? Let's say 1,000 units. And each unit, what is the cost? Let's say each unit is 500 rupees. Okay. Then what is the amount? 1,000 units into 500 rupees, you will get the amount here. What do you mean by the total amount? Total amount is the running total that you will put here. Okay. So likewise, you will enter all transactions into this day book. Okay. And where does this go? This goes into the sales ledger. Sales ledger. Now, while recording all the transaction, you come to the end of the month. You come to the end of the month. When you reach the end of the month, you will total all these amounts. Whatever the total amount of credit sales that you have done, this is the total. This total is taken into your sales ledger. Okay. So you might have sold it to Mr. B, Mr. X, LMN company, so many transactions. So all those transactions are entered into the day book on a monthly basis. And when you reach the end of the month, every end of the month, you take the total of the day book and transfer it to the sales account or the sales ledger. Because what you have done is called as a credit sale. So that total goes into the ledger in this form. You have recorded all the sales, and now with the total that you have there, that is this total that you get here, you will generate the double entry. What you do? You will debit an account called debtors with the total, and you will credit an account called sales in the total. Okay. So the result of a sales journal or the sales day book on a monthly basis, what do you do? With all the transactions that you have entered into the day book, you will transfer it to the sales ledger and the general ledger like this. What will go into the sales ledger is the account debtors, which is the control account. And what goes into the general ledger is the sales account, because you know all the nominal accounts are in the general ledger, which is sales is a nominal account because it's a, what do you call it? It's an income account. So as you see, I can explain it to you here. You see the nominal account, income. So all your day book, the day book total goes into the sales ledger and the general ledger, the double entry, debit debtors, credit sales. Very important. Debit debtors, credit sales. Similarly, now when there is a return happening, that is, you have sold a product, now this product is being returned. So what do? Again, you will go into a book called Sales Return Day Book, like this. Not this book, but you will have another book called Sales Return Day Book. Again, you will have the same details. Date, what was the invoice number, who is the buyer, description, quantity, unit cost, and the amount that he is returning. End of the month, what do? Similar to this, you will transfer it to the ledger. But now the accounts will differ. What do? You will debit an account called return inwards or sales return and credit the debtors. So let me explain it on the board, because sometimes what happens is you might have not understood this. Right. Let's look at this. Let's say you have done a sale to Mr. B for rupees 500,000. Rupees 500,000. So let us assume there are no other sales. This is the only sale that you have done for the month, the credit sale. So end of the month, what you will do? You will take the total in the sales day book, which is 500,000, and you will enter the transaction. Debit, debtors, credit, sales. Okay, and the amount will be 500,000. Now this is your journal. This is your journal. And for this journal, you will have a description also saying that being the sales made during the month of January or whatever. Now this is the sales that you have done. Now out of these 500,000 worth products that you have sold to Mr. B, and you have given a credit period of 30 days now. So he is coming somewhere on the 25th. This person, Mr. B, is coming with some products saying that those are damaged. Those toys are damaged. So he is going to return it now. So let's assume he is returning rupees 150,000 worth toys. Rupees 150,000 worth toys is returned. Okay, it's returned. Now what is going to happen? He initially bought goods for 500,000, but now he is returning 150,000. So when the customer returns it, I told you similar to the sales day book, now you will go and enter it in the sales return day book or the return inwards day book. What will you record? The quantity that was returned, cost per unit, and the total will be 150,000. Let's say that was the only return during the month. So you take the total at the end of the month, and now you have to go and post it into the ledger. Now you have to take it and post it into the ledger. What is the double entry? Now initially you said Mr. B to be your debtor. How much this debtor was supposed to pay you? 500,000. But by the end of the month, what has happened? 150,000 is already returned. So now this customer doesn't have to pay 500,000. What should he pay? He has to pay 500,000 less 150,000. So what will you do? You will go and reverse the debtors by 150,000. So when you reverse this debtor by 150,000, similarly what has happened? Initially you said you did a sale for 500,000. Now it is not 500,000 because 150,000 returned. So this also needs to come down by 150,000. But what is the significance here is we don't go and reduce the sales amount by 150,000. Instead, we debit an account called returns inward 150,000. You see, that is the most important difference between the two. In the case of a sales, you debit debtors, credit sales. In the case of a sales return, you debit an account called return inwards, which is an income account, and credit debtors account for 150,000. Okay. Now I'm going to raise this. I hope you have taken down. If not, just take it down. The two journals. Okay. Right. So still we are on the credit sale. And I'm looking at the same example. Now say, in the books of ABC company, you will have now Mr. B's account. Because I need to show that. ABC company will have to show the account of Mr. B. So in January, I had 500,000. Okay, that is the debit that I passed. What did I do? I credited an account called sales account. $500,000. So debit here, credit here. That is the first transaction. What was the second transaction that took place? Where the customer came and returned 150,000. So I had to reverse 150,000 from the customer's account because now he is not supposed to pay me 500,000. So what did I do? Write it here. So sales account Jan 500,000. Now the customer came and returned 150,000. So what did I do? I debited an account called return inwards. Return inwards account for January 150,000. I debited here and credited here. Okay, that is in the return inward daybook. Now, effectively, if you look at the transaction, you did a sale for 500,000 and 150,000 has been returned. So, effectively, what is your sales? What is effectively your sales? It is 350,000. 350,000. You see? So, what do we do actually when we are preparing accounts finally? We will net off the sales and the sales return. It will be net sales 350,000. Okay, just for your information, but we will learn how to do it in the accounts, right? So your sales will be net sales, 500,000 sales, 150,000 return. So I do a set off to show what is my net sales. Net sales will be 350,000. On the other side, customer brought in 500,000 sales and he returned 150,000. Now I do a balancing of this account. What do? I take the total of both sides. This side it is 500,000. This side it is 150,000. So which is the higher amount? 500,000. I put the higher amount on both sides. This side total agrees, but not this side. So what do I need to do? I need to bring in 350,000 so that now it balances. So if I bring 350,000 as per the double entry, I need to put 350 here. Now look at how this account look like. At the end of the month, Mr. B, I have a debit balance of 350,000, which means he is a debtor and he has to pay me, that is ABC company. I mean, me means ABC company. ABC company is supposed to receive 350,000. Okay, so your debtors is 350,000. Now, if you look at the whole example, this is in your sales ledger. These two are in your general ledger. In your sales ledger, it becomes a personal account. This is a personal account. But these two are impersonal accounts. You understand that now? So it is not relating to Mr. B. It is some common account that I am using in my general ledger. So these two are impersonal accounts because these two are income accounts. But here it is a personal account. So that goes into the sales ledger. This goes into the general ledger. Okay, so please take down. And please remember that these two does not need to happen in the same month. Huh? This can happen in the month of January and this can happen in the month of February. But here in this example, why I took it in January? Because the credit period offered is only 30 days. So because of 30 days, I just assume that it is happening in the month of January itself. Okay, right. Now let's look at the creditor. So now ABC company is going to do a purchase. From whom? XYZ. XYZ company. Okay. So what are you going to do? You do a credit purchase. Credit purchase. So when you do a credit purchase, what will happen? Similar to the sales, it is the right opposite of this. Right opposite of this. Okay. Right. So let's see how it works. So as I told you, the purchaser's journal or the purchaser's day book looks like this. Okay. How does it look like? Similar to the sales day book, you will have a date, you will have an invoice number because XYZ company has to give you a bill, and you will say supplier XYZ company. Description, you will say stationery. Quantity, let's say something 500 or whatever, and you will have to specify the unit amount, and you will put the total amount. Now what happens? End of the month, you take the total. You take the total, and that total you will translate to the purchasers ledger. Purchasers ledger, similar to the sales ledger. Now you translate to the purchasers ledger. Now purchasers ledger, what is the double entry? You will debit purchases and credit an account called creditors. Debit purchases and credit, sorry, debit purchases account and credit creditors account. Creditors account. Okay. Right. Now look at the book. So when the credit purchase happens, you will have to record the transaction. What are the two accounts involved? You will open an account in the books called, in the purchase ledger, you will have an account called XYZ company. And in your general ledger, you will have an account called purchases. Okay. Now this is your personal account of XYZ company, which is in the purchases ledger. This is the impersonal account or the nominal account, which is in your general ledger. So let's say ABC company did a purchase for 750,000 in January. So what will happen? You will debit purchases for 750,000 and credit XYZ company 750,000. So this is January. You have done the purchase. And you know, in this transaction, I took the example that XYZ company offers you 45 days of credit. 45 days of credit. So now let's assume that you don't take all the toys at once. No? So the stationery. So as and when you use only, you will take. When you go to February, you see that there are certain stationery items damaged or spoiled. What do? You want to return them. So you call XYZ company and say, look, out of the stationery I bought from you, there are certain amount of stationery which is in not good shape. I want to return them. So with the good relationship, business relationship, he says, okay, bring it. Now when you look at the total that you have returned in February is about 250,000 worth items you are returning. So what is the double entry now? You have to open a new account or in the ledger, returns outward, or you can call it as purchases return. Purchases return. So what you have purchased, now part of it you are returning. So when you are returning, what will happen? In Feb, you are returning 250,000. Debit XYZ company and credit return invoice. Return invoice. Okay. Now at end of February, when you try to balance this account, what will happen? You take the total of both sides. This side is 750, this side is 250. So higher amount is 750. So you will have to put a balancing figure here. And that will be your brought down balance. Okay. So what does this mean? You have made a purchase of 750,000, but you have returned 250,000 worth stationery. What will happen? Now you have a situation where, just like the net sales, you have a net purchase. Okay? Because you have purchased 750 and you have returned 250. So what is your net purchase? 500,000. And that 500,000, to whom you have to pay? XYZ company. You see? That 500,000. So this is how the debtors and creditors work. This is how the debtors and creditors accounts are operated. You have to be very clear with this. So here you did the balancing of the account and you have brought down the balance of 350,000, which is an asset to the company. Here you have balanced the account and the brought down balance is 500,000, which is on the credit side. The normal balance is on the credit side, means this is a liability. See, whatever that we learn, we take forward. Everything that we learn, you have to bring it into the context, how it refers. So here, the normal balance, you see, the normal balance is a debit, and that is an asset to the company. Here, the normal balance is a credit, and that has become a liability to the company. So, debtor becomes an asset, creditor becomes a liability. Sales and return become income, purchase and return becomes an expense to the company. Okay? So I hope this is very clear. If you have understood the sales, it is the right opposite for the purchase. So you don't have to worry much. If you have understood this, turn it the other way around. That is what that is. Okay? Is that clear? Right. Okay. Just give me a second. I'll see. Okay. So basically, this is about the credit sale and the return. This is about the credit purchase and the return. Okay. So I have worked on the T accounts as well for your knowledge. So you should be able to demonstrate in a exam question how to draw up these T accounts and how these double entries are recorded. So what you need to importantly know is the day books that are involved in the credit sale, the day books that are involved in the credit purchase. Okay, and the result of the credit sale will go into the books of sales ledger and general ledger, and the results of the credit purchase will go into the purchases ledger and the general ledger. Okay, and what are personal accounts and what are nominal accounts? All those now it has to be clear here. Okay, right. So getting back to the topic, this is about the purchasers journal and this is the return. Okay, and the return. So another important item that I need to mention about is in these two transactions. Now, when there is a return, whether it is a credit sales return or a purchase return. Now, when you do a credit sale or a credit purchase, you get an invoice or a bill. But what happens when you return something? When you return something, there is a particular document which you will make use of to record the transaction. So when a sales return happens, you will make use of a document called credit note. Okay. Similarly, when a purchase return happens, you will make use of a debit note. That will be the source document that you will make use of to record the transactions. Okay. Right. And then we get on to the cash book. So right now we have done about 4 day books: the sales day book, sales return day book, purchase day book, and purchase return day book. Okay, and all these are, mind you, theoretical. In practice, all these are dealt with the computer systems. So you don't see what is this day book, what is that day book, though you won't see those. It will be ultimately the computer system will throw out you the general ledger. Okay, so that is how businesses operate today. Now let's come to the cash book. Cash book keeps records of all cash transactions. As I told you, all cash inflows and cash outflows are recorded in the cash book. All receipts, all receiving money will be recorded on the debit side, and all payments that you do are recorded on the credit side. If you look at a T account, the T account will be having 2 sides of the cash book. Debit side will have all the money that you are receiving, and the credit side will have all the money that you are paying out. So in the cash books also, we have something called double column cash book and single column cash book. So there are instances where you use certain number of columns to represent the cash book. Okay, so that is one aspect, is the double column cash book. What are the main columns in the cash book is cash receipts and cash payments. I will explain this in a diagram. And we also have discount allowed and discount received in separate columns, which I will also explain. And the information of cash receipt books is used to update the nominal or general ledger and the debtors ledger or the creditors ledger on a monthly basis. Okay, right. What we will do is, first we will understand the structure of the cash book. Right. There is one slide here which I want to right. So let's look at the cash book. Okay. So cash book is also something like a T account. So what we do is here, okay, so let's call this as the cash book. Is the representation of the cash account. And you know, the left side is the debit, right side is the credit. So in the cash book, we have to have certain columns. We have to have certain columns. This is very important because in the examination also you need to sometimes present the cash book. So the first column that we are talking about is the date. Because cash inflows and outflows are recorded in the books and those are very important. So all debits you will record from this side, all credits you will record from this side. So when you have all debits, you have a date, and credits also you will have to put a date. Okay. Then you will have a column which shows the particulars or the description. What kind of a transaction this is? What kind of a transaction this is? What kind of a transaction this is? Okay. Thirdly, for this transaction, do you have any invoices? So we call it as invoice number. Invoice number. Okay. Invoice number. That is the third column. Then thereafter, normally we might have a column called, which I will explain to you. Okay. I will keep this space just for important. We have a column called discount allowed, and on that side we have an column called discount received. Okay. So you can mark it as and when I tell you. Date, particulars, invoice number, then there is a space which I will explain, don't write now. Discount allowed, so that is the breaking point. And then on to the credit side, date, particulars, invoice number, then there is a blank column, and discount received. Okay. Now I spoke about something called double column. Okay. Now don't write this, just listen, then when I tell you, you can write. If it is a single column cash book, what does it mean is, don't write it. We will name these two columns as cash. We will name these two columns as cash. That is, what is on the left side, you will name it as cash, right side also cash. Now this is a single column cash book. This type of a cash book is known as a single column cash book. Single column cash book. But if you go to one of the previous slides that I showed you, in a company, you can have transactions for receipts and payments in two forms. One is your cash, second is in the form of a check. Can you remember? I specifically spoke about payments or receipts or payments can happen in two forms. One is the physical cash that you may use, the other being the use of checks. Now, checks, of course, all of you might know, that is a document that you will make use of. So, where do you get this check? Checks are involved when you have a bank account. Checks are involved when you have a bank account. So as far as accounting is concerned, whether it is cash or a bank account, both are considered to be, end of the day, like cash. what do? You will have cash, and if you have it in excess, you will go and put it into the bank. And if you are in short, you will go and take it from the bank. So what happens actually, whether you have it physically with you, the cash, or you have it in the bank, both means the same. Both means the same. So it is very important. The cash and the bank are considered as same. So what happens in companies, if they don't have a bank account, or if they don't want to use the bank account similar to the cash book, they will only maintain one column. The single column will refer only the physical cash. Only the physical cash. But mostly what the companies do, they will make use of both these cash and bank together. So what they do is, instead of having a single column, they will break it into two. One for the cash and one for the bank. That's why I didn't want you all to write this. One will be cash, one will be bank. So now it becomes a double column cash book. Double column cash book. So let us go through the columns once again. This is the midpoint. So left side, date, particulars, invoice number, cash column. This is the amount column. Okay, this is the amount column, rupees. And here is the amount column again for the bank. And then you have a column called discount allowance. Again on the right side, date, particulars, invoice number. Again the two amount columns, cash and the bank. Finally, the last column is discount received. Okay. So now I want you all to take down this. Now it should be very clear to you all how these two left side and the right side of the cash book works. So in the cash book, whatever that you may receive, when you receive money, whether it could be in the form of cash or it could be in the form of checks, or whether you receive any direct deposits to the bank, all those are receipts recorded on the left side. Okay. Whatever that you may pay or your payments are recorded on the right side or the credit side. Okay. Okay, right. So before going in further, I would like to explain the two important terms. So we were looking at the two terminologies, the discounts that you may come across. So there are two types of discounts that we talk about when it comes to accounting. One is known as a trade discount. The other is a cash discount. Okay. So there are two types of discounts. One is the trade discount, the other being the cash discount. Now here is the summary. What do you mean by a trade discount and what do you mean by a cash discount? So trade discount is a discount given by the seller to the buyer as a deduction in the list price. As a deduction in the list price of the commodity is called a trade discount. Cash discount is something different, which is known as a deduction in the amount of invoice allowed by the seller to the buyer in return for immediate payment is cash discount. Okay. Now what happens in businesses, sometimes these type of discounts are used by the sellers to motivate the buyer to buy the product. Okay. So why you need to give discount? Now we also go for various types of purchases during seasonal time. Why we go during this seasonal time is because you see that there are a lot of discounts offered. Unlike during the other months, where the prices are very low compared to the seasonal times. So why we go on those times is because there are discounts offered. And what type of discounts are offered? You get the trade discount and the cash discount. So why a trade discount is given? Trade discounts are normally given to encourage buyers to go for bulk purchases. Bulk purchases. But cash discounts are totally different. That I will explain in a little while. So trade discounts, when are they offered? At the time of purchasing the product. At the time of purchasing the product. This doesn't involve any accounting entries. This doesn't involve any accounting entries. But when it comes to the cash discount, all these discounts involve a record in the books of accounts. Okay. Now I will explain this on the board so that you will understand what does it really mean. Okay. Right. Let's take an example. I'm just using this name. So you go to Avance. Okay. You are the customer. Right? You go and buy. So I'll take one example so that I can explain both. So you have Avance, one of the biggest companies in Sri Lanka selling appliances, home appliances. And this PQR trading company is a company which sells home appliances let's say I'm just taking a location, don't a company located in Mathura. Okay, I'm just taking an example, a location only, just for example. Now, what does this person do is, PQR trading company, they go and purchase from Aban's company, right? And then resell in Mathura. They buy products here, from here, take it to Mathura, and then there they sell it to various other people in Mathura. Okay. So this person have now come for a trade, that is to purchase 40-inch television, TV sets. Okay, 40 inches TV sets. And let's assume that the standard price for a TV set is 40 inches mean, let's say 60,000. I'm just taking an amount, 60,000. That is the standard price. If you go to buy, if you and me go to the shop, they will give it only for 60,000. Now, PQR trading company is not like that. They are a huge company in Mathura. So they are a biggest seller in Mathura for TV sets. So they go to Aban's and they do a bulk purchase. Bulk purchase means they might be purchasing, let's say 100 might be too much, let's say 50 TV sets. 50 TV sets. You and me going and buying 50 is not possible. So they are purchasing 50 TV sets in this bulk purchase. So now there is a bargaining. Now PQR trading says, look, I'm going to purchase 50 TV sets from you, and I want these 50 TV sets to be sold to me at 50,000 each. 50,000 each. Okay, now trading company, PQR trading company asks for this. Aban says, no, we are selling at 60,000, so it is very difficult for us to give it at 50,000. What we will do is, we will give it to you at 55,000 rupees each. Now what has happened here? Abans was talking about 60,000. This trading company, PQR trading company, came into the business and they wanted to do a bulk purchase. And they asked, can you give it to me at 50,000 each? But Abans in return, they say, no, I can't be giving you at 50,000, but what I can do is I'll give you at 55. Now what has happened? This is the list price. This is the list price. So from the list price, Abans has given a discount to PQR trading to 55,000, which means they have offered a discount of rupees 5,000, which is a trade discount. Which is a trade discount. See? Why I gave this? I'm now Aban's company. Why I gave this? To encourage bulk purchase. So at the time of the bulk purchase, what do? I will reduce my list price by some amount and offer the customer to buy more products, to encourage them to buy more products, so that I do a large amount of sale. When I offer a discount at that time, That is known as a trade discount. So now if you refer to the table that I have given in the handout, what is a trade discount? Trade discount is offered at the time of the purchase. At the time of the purchase to encourage bulk sales or bulk purchases, you reduce a certain amount from your list price. That reduction is called a trade discount. A trade discount. So here, who has given the discount? Aban's company has given the discount. Aban's company has given the discount. So they have allowed the discount and they have received the discount. But the problem here is this particular type of discount is a trade discount. A trade discount where you have a reduction in the list price which doesn't involve any reduction, which doesn't involve any recording of the transaction in the books. Okay, because this 60,000 is just a price that I had. I had a price tag, 60,000. I haven't recorded it anywhere. So now this person is coming and asking for 50 TV sets at 55. So I said, okay, you take it. I'll reduce 5,000 and give it to you. So I don't need to record any amount in relation to this 5,000 discount. What I will record is 55,000 rupees into 50. 55,000 rupees each into 50 means that is what my sale is. That is what is known as a trade discount. Trade discount. Okay, so I would like you all to take down this. So we'll stop there because I need more time to explain the cash discount, and because cash discount will have accounting impact also, so you need to understand that also. Trade discount is this, where there is no accounting impact, but this is the concept. So you need to understand the concept properly. Why a trade discount is offered? Trade discount is offered by a bulk company to induce more sales. So now when you give the discount, people, this PQR trading company will go and buy more products. Okay. So please make a note because I'll be using the same example next week to explain the cash discount. So better for you all to take down this and we will do it next week.